We get into the pitch itself, I'll introduce my team. Good afternoon, judges. Thank you for joining us today. My name is Jeft. I'm from the Singapore Management University, and alongside me is Rohan from the University of Oxford. Together, we are presenting our buy recommendation for Peloton with a projected 50% upside and a target price of $12.22. If everything is in order, we are ready to start our timer and begin our presentation. Thank you. All right, wonderful. So to begin, Peloton presents a compelling special situations opportunity. Following post-COVID overstocking and margin declines, restructuring efforts delivered a positive adjusted EBITDA of $3.5 million in FY24, sparking a 50% rally. Now, consensus is extremely cautious with a strong hold, trading at 18.6 times next 12-month EV/EBITDA, as well as well below its historical average. We believe Peloton's valuation disconnect offers significant upside. Our projected additional 11% product delivery growth, completely unaccounted for by the market, alongside sustainable cost cuts and deleveraging, supports re-rating and an intrinsically derived 50.4% blended upside. So Peloton is the world's largest interactive fitness platform with 6.6 million members, offering connected fitness products, CF, such as stationary bikes and treadmills, along with subscription services for digital fitness content. During COVID, Peloton's revenues naturally surged from increased demand and its stock peaked, but the company struggled post-pandemic, a shift we will elaborate on very shortly. In 2024, Peloton reported $2.7 billion in revenue with 44.7% gross margin and 17.6% EBIT margin, negative 17.6% EBIT margins. Historically, CF products dominated the revenue mix, but subscriptions now account for 63% of the top line growth.
Looking at key value drivers, subscriptions are driven primarily by connected fitness memberships, which represent 90% of subscription revenue. All access and guide memberships require existing ownership of Peloton equipment, while the rental scheme provides it. The churn rate tracks monthly user cancellations across all connected fitness subscriptions, and very importantly, this includes rentals. Physical products contribute the remaining 40% of revenue, primarily from Bike and Bike Plus sales.
So moving on to the broader industry, the digital fitness market in Peloton's operational regions is expected to grow at an 8.1% CAGR, with users increasing at a 5.4% CAGR through 2029. Likewise, physical fitness is also expected to grow. Peloton's unique competitive environment is characterized by two key verticals: interactive fitness platforms like Lululemon Studio and a broader competitive landscape, including gyms and stationary bike companies. Holding 74% of the fitness subscriptions and 42% of the physical product markets, Peloton plans to expand with equipment such as its treads and rows to further solidify its leadership in the industry. To provide further context, Peloton experienced explosive growth in FY21 driven by lockdown demand. This led to them overcommitting inventory and adding expenses to their fixed cost base. However, as COVID subsided, gyms reopened, subscriber growth slowed, deliveries fell, and revenues declined, leaving Peloton with excess inventory and high expenses. Rising COGS, OPEX, product recalls, and markdowns drove EBIT margins to negative 76.3%. And to sustain operations, Peloton raised $750 million in debt, but burned $2.4 billion in free cash flow in 2022. As such, a restructuring was initiated, with FY24 cutting year-on-year OPEX by 21%, achieving $3.5 million in positive adjusted EBITDA, with a targeted $200 million in total expense cuts by FY25. So, has the market priced in a turnaround? After peaking through COVID, Peloton faced a sharp sell-off post-pandemic due to the issues mentioned earlier. Since then, the stock traded sideways until 2024, where not necessarily top-line performance, but adjusted EBITDA surprises drove a 50% rally. Today, we are at a stalemate. While the stock trades slightly above the peer average EV/EBITDA multiple, it remains below its own historical mean. So, while the market has at least partially priced in a turnaround, it's cautiously taking a wait-and-see approach and undervaluing Peloton's fundamental potential. This situation presents a valuation gap for a long position if operational improvements prove sustainable.
Our first thesis centers on intricately studying subscription churn rates, uncovering an imminent renter-to-buyer transition that the sell side has entirely overlooked and failed to model. Until 2022, Peloton's subscriptions simply offered existing equipment owners access to live and on-demand content, maintaining stable annual churn rates of around 0.7%. In Q3 22, Peloton introduced a new bike rental scheme with an option to buy out the bike at a later stage. Previously, subscriptions were limited to existing equipment owners. Through the new rental scheme, non-owners could now trial Peloton's bikes. This rollout spiked sudden demand, temporarily doubling churn rates during the pilot and nationwide launches. Interestingly, there was an unexplainable phenomenon of churn rates persisting up to 60% above historical averages, even 12% after the rental program's launch. Through primary interviews and web scraping, we pulled alternative data on Peloton's rental contract structures, identifying that the economically optimal buyout period for renters typically occurs at 6, 12, or 24 months into their rental. We've defined a transition state subscriber set, encompassing past renters now reaching these economically optimal buyout windows. Previously unexplainable high churn rates 12 months post-launch align with our proposal. Churn spikes are a direct, unique, and measurable indicator of renters canceling subscriptions to purchase the bikes they've been renting, a key top-line driver completely missed by the market. With 12 to 24 months ago subscriber growth peaking in FY23 and 24, the recent Q1 25 results precisely validate our edge. Churn rates rose year on year to 1.9% from 1.5%, matching the exact magnitude of increase in Bike and Bike Plus sales as a percentage of our defined transition state subscriber set. Now, we expect imminent major waves of rental conversion buyouts stemming from the significant subscriber growth of FY23 and 24, a critical additional driver entirely overlooked by sell-side models. Quantifying our edge, our model shows that imminent renter-to-buyer conversions will contribute approximately 11% of total product sales through FY29. While churn-driven equipment sales are primed to drive top-line growth, sell-side is narrowly focused on subscriptions, fundamentally misjudging Peloton's growth trajectory. Furthermore, Peloton's churn rate conceptually represents a notably unique case, making it widely misunderstood. Unlike traditional TMT subscription models where high churn is negative, Peloton's rental subscriptions inherently require churn for product buyouts. This makes elevated churn not simply a liability, but also a strategic indicator, a key insight we've identified. Additionally, historic inventory clearing discounts have stabilized Peloton's equipment stock levels. Management plans to meet rising product demand with higher pre-COVID pricing, driving balanced growth across both subscription and product segments by FY29. Moving on, we argue Peloton's restructuring fixed cost reductions are sustainable long-term. With a 30% expense reduction from FY22 to 24, our 2025 forecast aligns with consensus, but we differ significantly in our longer-term outlook. To begin, we project sales and marketing costs to stabilize at current levels, 11% below analysts who view such low spending as unsustainable for customer acquisition. The evidence decisively disproves the consensus view. Firstly, Peloton's LTV-CAC ratio, which compares customer lifetime value to acquisition cost, rose from 1.5 in the previous quarter to 1.9 in Q1 25, despite a 44% year-on-year reduction in S&M expenditure. Management's targeted marketing strategies are clearly working, and while LTV-CAC approaches their 2.5 medium-term target, the sell side wrongly focuses on gross subscriber additions instead of profitable acquisition. This leads to our second point. While total subscriber growth may slow, Peloton is prioritizing acquiring profitable high-value customers. This is evident in a 15% increase in average revenue per subscriber from $39 to $44 over just the past 2 years. This quality over quantity strategy drives sustainable growth, which consensus overlooks. Finally, our alternative data highlights significant potential for organic growth. Peloton's cult-like community on platforms like Reddit ranks in the top quartiles of member engagement. Even purely in size at 800,000 plus members, it's nearly 10 times larger than any competing cycling or fitness community, including Apple Fitness. Complemented by the industry's highest Net Promoter Score, this strengthening brand awareness clearly indicates the current S&M costs are highly efficient, effective, and sustainable. For G&A, we're slightly below consensus, attributable to third-party retail partnerships with Amazon and Costco, enabling asset-light expansion and scaling without a reliance on showrooms. And for R&D, we're 3% above consensus, consistent with our thesis that Peloton will increase investments in retention-focused innovations to grow customer lifetime value. As thesis 1 and 2 converge, the revenue shift from high-margin subscriptions to lower-margin equipment sales will temporarily compress gross margins. However, our model indicates that the fixed cost reduction will offset this, driving EBITDA margin expansion to 18%. It's EBITDA surprises, as noted by my teammate earlier, that have historically triggered stock rallies. Combining thesis 1 and 2, our edge lies in identifying and exploiting market confusion around Peloton's growth drivers. I'd like to draw your attention to this. JP Morgan projects 610,000 unit sales in 2026, while CG is just at 399,000, a 53% variance for a key revenue driver, despite both brokers maintaining a hold rating with similar target prices. This unheard of discrepancy in estimates across the broader street is not typical sell-side variance in assumptions. It reflects a fundamental fundamental information asymmetry. Importantly, our primary renter-to-buyer transition thesis has been entirely overlooked by all sell-side analysts, with the sole exception of JP Morgan. Even then, the top-ranked analyst arbitrarily hard-codes a 65% year-on-year unit sales growth for 2026 without providing an explicit rationale anywhere. While JPM's analysts correctly anticipated increased unit sales, thereby validating our first thesis, like the rest of the street, physical product COGS were modeled as a percentage of revenue, a conceptual flaw. Per unit economics, equipment COGS should be tied to units sold, not their selling price. With upcoming price hikes, consensus, including JPM, has failed to decouple price increases from COGS. In contrast, our regression analysis of historical equipment COGS against units sold yielded an extremely strong R-square of 0.9 and a p-value below 0.0001, indicating complete statistical significance. Our model forecasts 2026 product COGS at 81% of revenue, compared to JPM's hard-coded 86%, a striking 5% difference. While JPM's analysis supports our first thesis, the failure to account for EBITDA margin expansion, just as with the rest of the street, as outlined in our second thesis, reinforces our complete edge over the market. In extreme market confusion, we have established a clear information edge with a fundamentally driven long-term thesis, not simply an event-driven catalyst. In fact, the surge in product sales will drive about a third of converting rental buyers to immediately resubscribe to Peloton's $44 a month plan for online classes, which was previously already included in the rental membership. So analysts are wrong on two fronts. First, they fail to predict the surge in product demand, and two, they underestimate upcoming subscriber growth. On top of rising product deliveries, an imminent, unaccounted for inflow of recurring subscription revenues currently positions Peloton as an incredibly compelling deep value opportunity.
Finally, consensus also underestimates Peloton's restructuring benefits. Despite bottom credit health rankings compared to peers due to negative profit skewing risk models, default risk is at multi-year lows. To further validate this thesis, our stress test revealed minimal covenant default risk of the 1.2 billion subscriber revenue and $250 million cash balance minimum, even under stress case 3, where we inputted a severe 4.5% rate hike and worsened operations from the bear case. Peloton breaches its cash covenant only in the repayment year. Nonetheless, it can fully repay debt with a 1.1 times DSCR, 7.8 times interest coverage, and a minimal refinancing risk at 0.2 times at maturity. Peloton's stable debt profile supports value creation. Covenant-like terms and balloon amortization leads to free cash for inventory growth, working capital optimization, and ultimately unlevered free cash flow release. CapEx can also increase as per management guidance, fueling Peloton's operational plans that will enable revenue generation. Throughout their restructuring, consensus has re-rated Peloton with multiples rising 4 times as operational improvements unfolded. Yet, the market currently assigns outdated NTM EV/EBITDA multiples of 9 to 13 times based on irrelevant comps like cruise lines and gambling companies, undervaluing Peloton's progress and sustained profitability potential. As deleveraging continues and Peloton approaches a net debt to EBITDA ratio near 0 by FY27, its financial profile aligns closely with Garmin, a premium subscription and hardware-driven business. This supports a bull case multiple of 20.2 times EV/EBITDA, which is the 75th percentile in the concept, backed by recurring revenue and operational efficiency. And at the very least, an 18.6 time multiple, which is what they are currently trading at as a base case, justifiably above their tier 1 concept median of 14.8 times. With that well managed, operational improvements solidified, and steady state profitability on the horizon, we believe a market re-rating is inevitable. Transitioning from a restructuring to a sustained growth, Peloton is poised for long-term value creation. For valuations, we used 3 methodologies. Fundamental DCF, an FY26 exit NTM EV/EBITDA multiple aligned with sell-side methodologies, and an NTM FY26 EV/EBITDA exit. We assigned 80% weight to the DCF GGM, emphasizing long-term cash flow generation and sustainable growth. This approach captures Peloton's transition into a stable state cash generative business. The remaining 20% is divided between NTM EV/EBITDA and the DCF exit multiple methods, highlighting the shorter-term re-rating potential and key operational milestones driving Peloton's rally. Our balanced approach integrates long-term fundamentals with short-term sentimental drivers, resulting in a credible final target price of $12.22. Moving forward, at latest by Q1 26, we expect to see our first absolute increase in CF product sales. First top-line beats may occur as early as Q2 2025 from our churn conversion premiums materializing. Finally, FY26 EBITDA margins exceeding consensus at 13% reinforce investor sentiment, supported by cost discipline and operational success. With net debt reducing to 0.9 times with the 190 mil bond repayment halfway through our five-year forecast going forward. Peloton's balanced revenue streams and expanding margins, as well as deleveraging, position it as a steady-state cash-generative business. As for macroeconomic risk, Peloton's price-insensitive customer base mitigates this. 34% of Peloton consumers purchase their products because they are the best exercise equipment, with the value for money not being a top priority. Execution risks remain tied to covenants and rented-to-buyer success. But with sufficient headroom, such as their opening $700 million cash and $1.7 billion in subscriber revenue at FY24, Peloton will comfortably service that in all downside cases, even if you kept revenues flat. As they continue to hit milestones, Peloton is primed for growth. We reiterate our target price of $12.22, reflecting a 50% upside. Thank you. We are grateful for the opportunity to share our thesis with you, and we will now take questions, leaving up this summary for your reference.
So I'd like to get in, I think you mentioned here that previously they'd limited purchasing subscriptions to consumers that had previously bought the product. Is that correct?
Yes, connected fitness subscriptions, which account for 90% of subscription revenue, those before the rental program rollout were basically offering digital and online classes only if you had Peloton equipment. So if you didn't have it, it was pointless. They do have a separate digital subscription platform, which is far lower in monthly prices, and those are offered to everyone. But those aren't part of our thesis, and it's less than 10% of subscription revenue, but that is a standalone case, yes.
Okay, so and part of the thesis is the churn rates, the higher churn rates aren't necessarily a negative thing because they represent people switching from being a renter to a buyer.
Yes, so they are, yes, please, sorry.
No, go ahead.
I was going to say, so churn rates are inherently a bad thing. The way our model works is that when a subscriber churns, our downside does go down. It's not profitable for the company. That being said, when your churn rates hover at about 0.7% for years consecutively, and suddenly you have a rental program rollout for which churns are inherently a part of a buyout process, you have to understand that when your churn rates triple from 0.7% to something like 1.9% in Q1 25, that doesn't just mean the sell side should say, okay, we were modeling 0.7% of subscribers to leave each month before. Now we'll model 2% of subscribers to leave each month moving forward. They end the story there. But the mistake is that a large part of these churns are converting to buyouts, and the churn rate spikes coincide perfectly with the economically optimal time for a renter to initiate a buyout based on the way Peloton structures its rental contracts. So what we're saying is, one, you have to account for the fact that some of these churns are going to translate into product sales, which none of the sell-side analysts have done. And secondly, the point is that even when you churn your subscription, your rental subscription to buy out a Peloton product, the concern becomes, okay, is this a short-term catalyst? Is that the end of the story? The answer is no. So a lot of the people who actually will end up churning their subscription to buy out a product, they will instantly become resubscribers, but now on the cheaper $44 a month plan, which gives you access to digital classes, online lessons, things of that sort. And that means that the sell side has not only not forecasted the increase in unit sales, but they've underestimated the subscriber growth moving forward as well. So it's sort of a twofold mistake on their front.
Okay, got it. And then I guess the second bucket for me is you guys have framed, I think, the overextension during COVID as an increase in fixed costs and over leveraging on inventory and so forth. And I sort of saw the issue with Peloton over this period as two-pronged. One was this overextension that you guys have captured, but the other part was, the reason there was an overextension there was an expectation of prolonged and extended heightened demand that just didn't materialize. And so I see it as a cost issue, but also as a top line issue, and something I think maybe you touched on the details later, but yeah, I'd like your thoughts on where are top lines trending. And I understand that this is a premium product, that there's some demand resiliency there. But one of my concerns is at a very high level, this seems to stem from a demand side problem in that, that this was a heightened, hyped up product during COVID. And thereafter, as you mentioned, people are going back to the gym. Maybe the consumer isn't as strong. And so people have less spare time, they're going back to their jobs. How do you think about sort of the demand side top line issues that I think are probably going to carry through to 2025, 2026?
Yeah, well, we have looked into this. So if you were to ignore the outlier years, which is essentially COVID-19, the trend post-COVID-19 and pre-COVID-19 is still an overall upward trend. Demand from the consumer, currently Peloton primarily targets consumers, but they also have multiple channels such as B2B. So they sell their Peloton bikes to companies, gyms, and as well as like partnerships with other firms as well. Currently, the demand going forward from here, from the consumer side, we still see a demand. Currently, the subscribers in their rental programs have been growing, although it has slowed a bit because of post-COVID normalization, but this is to be expected. In fact, our model accounts for this. In 2025, 2026, we aren't really forecasting a huge growth in revenue, but we are forecasting it to be picking up post FY26 onwards to our 5-year period. So essentially, as of now, we are seeing a bit of a normalization, but it will pick up towards the end of the 5-year period forecast.
Thanks, guys. I had a question related to valuation. So you spoke a lot about how you think the company is mispriced relative to its historical average, but I think the historical average was in the kind of same time period David's talking about, when not only were you forecasting more demand, but also just multiples in general were, you know, inflated due to low interest rate environment. And so I guess, and I didn't hear, maybe I missed it, but I didn't hear much about how it's mispriced relative to comps. I think you spoke about how other analysts are maybe comparing to like other comps that aren't as relevant, like gambling and whatnot. So maybe like if you could talk about how the 18 times is low relative to other comps currently.
All right. So essentially, if I were to go to the slide here, let me find it. Yeah. Okay. So currently, their current multiple is 18.6. Historic, like looking on a 1-year basis from 2024, their mean is 22.2 times. So they are currently trading below their mean NTM EV/EBITDA multiple. So they are hovering around between their -1 standard deviation and their current mean. So in relation to comps, yeah. So currently, the consensus don't even know how to find comps for Peloton. So if you were to go to the appendix slide, yeah. So essentially, they don't know how to place Peloton in terms relative to other companies. So essentially, they just took a bunch of different vertical subscriptions as well as physical products and then best-in-class hardware, and then they essentially just mix this together to derive a median multiple or an average multiple, depending on their house view. And if you look at Argus Equity Research, their comparables include DraftKings, Norwegian Cruise Line Holdings, which don't even purchase as much Peloton bikes as you would assume, Boyd Gaming Corp, which is all essentially gaming. And these comps don't really reflect much of Peloton's business or where we think their business is going. So currently, if we look at our comps that we used, yeah, if you looked at our comps we used, we had tier 1 and tier 2. Essentially, we took what consensus has used as their peer comps, and then we narrowed it down to essentially a tier 1 comp set, which is what we think best reflects Peloton. So we have Technogym, Lululemon, Under Armour, Nike, and Garmin. And these comps were picked specifically because of their involvement in tech, actual clothing, as well as in being in the fitness space in general, and also being a turnaround story. So when we took a tier 1 concept, we derived a more accurate EV/EBITDA multiple to use in terms of our valuations. And basically for the bull case, we are saying that they should be trading at a level such as Garmin, which is essentially a subscription business and a hardware business that mirrors Peloton very, very closely.
Thanks for that. I had a quick follow-up to that too. Obviously Peloton had a few product recalls back in May 2023. Quite a few recalls, and as we're transitioning from a subscription to a buyer environment for consumers, that recall is somewhat mitigated by the fact that when you're in a subscription environment, by the fact that, if you're renting out these bikes, you don't really have a problem with them having, permanent hardware issues as much. But if you're moving to more of a buy model, that becomes a lot more of a consumer trust issue. So would just like to hear your thoughts on, how you see these product recalls affecting sales in the future, especially when moving to a buyout model, if at all.
Could we start with Appendix 1, please, Jeff?
Yep.
And I'll leave the floor to you. This is a really good question, one that we looked into, and fortunately we have an answer for you. It's in the bottom right of this chart. So there was a survey conducted on the levels of trust in Peloton following the 2021 treadmill recall. And what it turns out to be the case is that approximately 86% of their consumers, consumers in general, reported that they had either unchanged or increased confidence in the brand post Peloton's recalls. So in terms of an effect on top line growth, for one, it seems that there's a direct answer that fortunately consumers have been relatively unfazed by the situation, broadly speaking. And even so, moving forward, if you look at their income distribution of the potential clients that we have in the top right chart, I mean, we're looking at more than 80% of them being in above average income brackets in America. So they're price inelastic, and their priorities, as we will see in the bottom right again, the priorities when looking at Peloton's product purchases is simply we want the best equipment. And so if there's a price premium involved, then so be it. But in terms of directly transferable impact to the top line, it's not as apparent as we would have imagined based on the data we're seeing, but I'll leave it to my friend to elaborate more if he has more to share.
With regards to the product recalls, these were essentially caused because of the huge supply they were giving out during COVID-19 to meet demand. So ultimately, this led to huge issues with their manufacturing. Post COVID-19, you won't see that much issues with product quality or quality control. In fact, I don't think there has been a significant major recall there hasn't been a significant major recall in the most recent year. So essentially, things have been improving in regards to quality control of their equipment. So essentially, I don't think this is an issue going forward. So far, everything has been going well. Demand is controlled. Their supply lines, their supply chains, and the manufacturing capabilities are essentially all in a very manageable rate. So essentially, what you'll see is, and what has happened is essentially no major product recalls or no major controversies surrounding their equipment.
All right, thank you guys.
All right, thank you.
Great work. Appreciate you presenting, but we need to move on. But
Yeah, cool.
Thank you guys.
Thank you, guys.
Guys.
Thank you, guys.
Yeah, much appreciated. Have a good day.
All right, cool. Good afternoon, everyone. My name is Aadi, and I'm joined by my teammates Nayan, Mithun Kumar, and Ryan Sun. We would like to thank DIPP for the opportunity to compete in the Buy the DIPP competition. And with that, we're pitching Micron Technology as a long position with an upside of 37.77%, resulting in a price target of $145.7. So Micron's a semiconductor company that sells memory and storage chips. Its current price sits at 2/3 of its 52-week high due to overstated pessimism stemming from recent headwinds. A disappointing Q2 earnings forecast caused the stock to drop 17% because of weaker than expected revenue projections. The lower EPS was attributed to the industry-wide NAND oversupply and reduced customer demand for the automotive and personal computing chips. Demand in the PC and smartphone sectors dropped by 19%, driven by the shift to the cloud computing and prolonged PC refresh cycles. This trend highlights a broader move away from traditional hardware upgrades. Moreover, in the AI sector, sentiment has started to shift. While investors remain hesitant despite Micron putting up 400% in year-over-year growth in data center revenues, recent partnerships with NVIDIA for its H200 GPUs bolster its long-term outlook. The stock movement timeline highlights investor concerns with Micron's cyclical volatility driven by changing market conditions. Indeed, peaks occur during periods of positive earnings and optimism around innovation like AI, whereas troughs result from weaker consumer demand, oversupply, and cautious forecasts. But when you strip away the overstated street negativity, you're left with a fundamentally strong company currently capitalizing on high growth markets. This breaks down into 4 core theses. One is that Micron is positioned for substantial growth across multiple sectors, with a rebound anticipated but not yet reflected in its valuation due to overstated near-term pessimism. 2, Micron has made strategic investments in high growth markets such as HBM, 3D NAND flash, and ADAS. And 3 is that its focus on high margin specialized products allows the company to mitigate pricing pressures caused by oversupply of commoditized DRAM and NAND. And finally, 4th, it maintains above industry average core competencies and a strong commitment to R&D, solidifying its foundation for sustained long-term growth. Now onto the valuation scenarios. In the base case, we project sustained growth for Micron, especially in the AI-based sector, and that customer inventories will stabilize by spring of 2025, enabling a revenue rebound. And in our bull case, we project a continued success in securing partnerships like their recent collaboration with NVIDIA, as well as delays in Samsung's HBM development, giving it an opportunity to capture greater market share. Now, for the business overview, I'll hand it over to Mithun.
Thank you, Aadi. Micron is a producer of memory and storage solutions, which include DRAM, NAND, and NOR chips. These are further broken down into 4 segments. Firstly, Micron's compute and networking business unit generates the largest share of revenue, focusing on providing high-performance memory solutions for data centers, AI, and machine learning applications. Notably, Micron's data center revenue saw over 400% year-over-year growth in fiscal Q1 2025, which was driven by demand for high-bandwidth memory chips. Second, Micron's mobile business unit provides memory and storage products for the mobile device market. MBU is currently navigating excess inventory from a 2023 demand slump. Third, the embedded business unit supports industrial, consumer, and automotive sectors. A key growth driver here is the rise in demand for automotive driver assistance systems, which increased segment revenue by 11% in 2024. Finally, the storage business unit focuses on NAND-based storage products, which are seeing robust growth due to advancements in SSD technology. Moving on to the competitive landscape, the 3 main players in the memory market are Micron, Samsung, and SK Hynix. In the NAND flash market, widespread inventory backlogs and softened demand have led to significant price declines in early 2025. However, scaling back production, there's a strong likelihood of demand recovery by the second half of the year. Micron stands out in this space with its G9 NAND technology and its business-to-business focus. The DRAM and HBM market is highly consolidated, with 90% of the market share controlled by the 3 main companies. The rise of generative AI has significantly boosted demand, as large language models require faster memory. Micron saw the highest growth in this space as a result of its HBM3E technology. Data center SSDs are projected to grow with a 16% CAGR through 2032, as data centers integrate specialized SSDs for AI applications. Micron's SSDs offer 34% higher output and 80% lower consumption compared to competitors. Now moving on to Ryan for the investment thesis.
Thanks, Mithun. Our first investment thesis point is that recent near-term pessimism surrounding industry challenges provides a compelling entry point. Looking at past industry dynamics, the memory chip industry faced a large downturn in 2023 as a result of pandemic-era oversupply and began to recover in 2024 with rapidly accelerating growth in AI-driven markets. While analysts remain bearish due to Micron's uncertain Q2 outlook, we view this as an overreaction, presenting a compelling opportunity for investors to capitalize on a promising entry point. Micron's focus on inventory optimization and cost management will allow it to tackle these near-term headwinds that we think will allow for inventory stabilization by spring of 2025. Looking at the top right graph, we see that the stock price rebounds significantly every time earnings per share reaches a cyclical low. After reaching a trough at the end of 2023, the EPS has been rising along with the rebounding stock price, showing we are in the middle of an upcycle. We believe AI trends will continue this upcycle through 2025 and 2026, presenting significant upside. Now for our second point. We believe that Micron's most promising feature lies in its unique position to capitalize on rapidly expanding markets. With the increasing adoption of AI training and inferencing, we are seeing a surge in demand for higher memory capacity and bandwidth. We're especially excited about HBM, which is essential in AI applications and is projected to exceed a TAM of $100 billion by 2030. Micron's industry-leading HBM3E offers superior power consumption and memory capacity over its main competitors. As a result, the company has established contracts with predetermined pricing that have fully booked out its 2025 capacity. And with predictions to reach a market share level of about 20% in the HBM market, Micron is in a great position to significantly boost its revenue. Micron also has potential for more upside with growth in other markets. For instance, in the upcoming PC refresh cycle with the Windows 10 end of life, we'll see that this will spark a transition to next-gen PCs requiring greater memory loads. And there's also room for growth in the automotive industry, resulting from ADAS requiring greater memory usage. Many investors overlook these growth opportunities, mistakenly viewing Micron as just another competitor in the commoditized DRAM and NAND chip market. In truth, we see that Micron is evolving into an AI-focused chip manufacturer with significant growth potential across multiple high-demand segments. Another significant piece that investors are missing is Micron's strategic shift to developing high-margin products that reduce exposure to market cyclicality. Recent product launches such as HBM, server DRAM, and high-capacity DIMMs boast more customization and greater margins than standard legacy products. Evidence of this shift can be seen by legacy DDR4 and LPDDR4 products now only making up 10% of DRAM revenue. These products give Micron more pricing power due to their advanced capabilities, which mitigates the risk of down cycles. Furthermore, HBM4E, which is making development breakthroughs and expected to begin mass production in calendar 2026, will allow for even more customization. This displays Micron's transformation from a producer of commoditized memory products to highly customized client-approved orders, giving Micron a greater competitive moat and differentiation in the market. Now, passing it off to Nayan.
Thanks, Ryan. Moving into our fourth investment thesis point. In addition to the growing demand from generative AI, Micron's long-term strengths ensure it can fully capitalize on the incoming memory growth cycle and maintain a clear edge over competitors through its unwavering focus on R&D. Notably, Micron's materially stronger EBITDA margins and lower leverage ratios than peers position it to outperform during the next industry upturn. Looking at the graph on the top left, we can observe Micron's dedication to R&D despite the recent cyclical slowdown, an indication of management's strategic long-term vision. Additionally, Micron's long-standing relationships with customers like Apple, NVIDIA, and leading cloud providers, coupled with impactful R&D collaborations and new facilities backed by government incentives, firmly places Micron at the forefront of cutting-edge chip development. Now moving on to segment growth assumptions. While data centers already generate over half of Micron's revenue, and this share is expected to grow, we conservatively forecast this segment to remain at roughly 50% going forward. Additionally, we project low single-digit growth in the smartphone segment, in line with Micron's management guidance for modest handset demand. Additionally, we remain highly optimistic about Micron's embedded segment, and we believe ADAS adoption will serve as a powerful long-term demand catalyst for Micron's high-performance memory solutions, leading to a strong rebound once current market headwinds subside. Additionally, we model normalized gross and EBIT margins of 47.8% and 35.8%, respectively, reflecting Micron's solid operating efficiency and a return to Micron's upcycle margins. Furthermore, we account for the current revenue upcycle beginning in Q1 2025 and demand bottoming out in 2027. Moving on to the valuation, our discounted cash flow analysis yields a target price of $145.70 per share, implying 37% upside from current levels. Given Micron's superior margins, prudent balance sheet management, and forward-looking R&D strategy, we see it as a compelling opportunity for investors seeking to benefit from the continuing upswing in memory demand. Looking at the comps table, Micron stands out among its peers with strong forward revenue growth and competitive margins. Micron serves a diverse array of key customers like Apple, Microsoft, and NVIDIA, ensuring steady demand for its cutting-edge memory and storage solutions. Now moving on to Aadi for our variant perspective.
So thanks, Dan. So the first street concern is that consumer-oriented headwinds and slower adoption of Micron's AI-based products will shape the company's outlook, weakening overall revenue recovery. So currently, the street is overreacting to the Q1 earnings report, whereas what we see is that inventories are expected to adjust by spring of 2025, which will stabilize demand and allow production to ramp at a steady pace. Concerns 2 and 3 can be addressed by the same underlying point. So the second street concern is that the semiconductor industry is oversaturated with an abundance of big-name players and legacy products contributing to shrinking consumer markets. And the third is that the lack of a significant economic moat and insufficient scale of Micron subjects the company to risks from the highly cyclical nature of the industry. To these 2 points, we would say that the street isn't seeing that Micron's carved out a forward-looking niche with premium products. So generally, commoditized DRAM and NAND products must forecast the demand that they expect, which, when they don't hit on the dime, leads to oversupply. We would say that Micron doesn't have to be the manufacturer with the greatest scale to have an economic moat. Instead, its advantage comes from specializing in highly customizable products and placing their long-term investment focus on high-margin custom offerings. This allows them to carve out a niche and avoid the risk of oversupply and vulnerability to industry-wide down cycles that stem from forward bookings. Additionally, consistent R&D spend has allowed them to position themselves in high-growth markets that we've mentioned, which will also see less cyclical lows due to sustained demand. Now, moving on to some risks. Great. So the first risk is geopolitical tensions, specifically in regards to China. There are concerns surrounding potential increases in tariffs, the threatening posture towards Taiwan, and also China's restrictions on certain Micron products. And the mitigant to this is that the company has diversified its manufacturing footprint across East Asia, and it's also scaled back its presence in the Chinese market. The second risk is that the highly cyclical nature of the semiconductor market results in fluctuating gross margins and free cash flow. And our mitigant was that despite the industry's capital-intensive nature, our management has shown a track record of smart capital management, which has positioned Micron well for future upcycles. The third risk is steep technological competition. So competitors like SK Hynix and Samsung have greater market share and higher access to capital, which concerns some analysts. But our mitigant to this is that Micron's focus on high growth markets specifically, like HBM and NAND for data centers, strengthens its economic moat. And yeah.
Oh, you guys
Ryan?
have 2 minutes left, just FYI, or whenever you guys are done.
And now finally, moving on to some additional considerations. While most of Micron's revenue is US based, international markets should not be overlooked. Micron's geographic diversification allows it to align its production with regional demand, ensuring a steady flow of high-margin premium products. Micron utilizes an iron triangle supply chain strategy, allowing them to balance cost, service level, and lead times to optimize their production. We also have very strong confidence in Micron's management team, whose decades of experience in the semiconductor and technology industries have consistently delivered results. Their proven expertise positions them to drive Micron's expansion into rapidly growing markets while upholding the company's operational efficiency and competitive edge. Another consideration is that Micron is notably the only US-based memory company, which provides Micron with a greater shield from external geopolitical risks. And lastly, recent headlines have increased analyst optimism surrounding AI growth, which has boosted semiconductor stocks industry-wide. And we see this news as proof of our investment theses beginning to play out. And with that, we're open for questions. Thank you.
Thanks, guys. Quick one from me. I think a key thesis point as well as mitigant to some of these downsides that at least the street has brought up is that these guys are offering tailored products, right? So there's a degree of customization there. And you also spoke to, partnerships with NVIDIA and Apple and so forth. And so I was wondering if you could speak to, the products that they are customizing and who they're selling those products to and the sustainability of that moving forward. And obviously, customization is expensive. And the flip side of that is it drives, higher margins on the product side. But that doesn't necessarily drop through to the bottom line. So I'm interested in hearing, your thoughts on the customization piece as well as the partnership piece.
Right. So I think it'll be helpful if we go back to one of the previous slides. Yeah, this one. So here we're talking about kind of that part you're talking about where how they're creating these higher margin products that are more customized. And one of their most promising features that we highlighted was their HBM market, where their main customer here is NVIDIA and some other key players. So their HBM3E that they're currently selling now and are fully booked out for 2025 is very customized, and HBM4E will allow even greater customization with the logic-based die. And this is going to allow them to further boost their performance of this by over 50%. So again, like with the part that you mentioned about costs, there is a trade-off here, but we think that they are carving out a nice niche for themselves by placing themselves and orienting themselves into these higher margin and more customized products, which is going to reduce their risks of down cycles.
And this is for AIML, for their main client? Okay, gotcha.
Yeah.
Great pitch, guys. Thought this was very interesting. I guess my main question would basically be if we go back to your model and what you're kind of thinking about in terms of Micron's end users, I think you build out kind of aggressive growth in the embedded industrial side. I was basically wondering if you think that the thesis for Micron is driven by this upcycle in industrial, why wouldn't the better expression there be long something like analog, like an Infineon or something, which has more direct exposure to this and is cheaper? And then I guess on the flip side, in terms of the HBM growth, why Micron versus something like a Hynix that's a pure play HBM name? I guess I guess both of those pieces could be interesting to discuss.
Sure, that's a good question. I can speak to a little bit about that. So as to why we didn't choose Hynix or other companies like that, specifically with Hynix, Hynix's revenue mix isn't as favorable as Micron's. I think Micron gets half, and half of their revenue is coming from the CNBU segment, which is more AI and data center aligned, whereas SK Hynix is 40% and also isn't growing as fast. So I think that's why we chose Micron. They have a better revenue mix. And could you repeat the first part of your question?
Yeah, so the first part of my question is basically like in your model, you assume like the ADAS and like automotive demand recovery piece essentially driving like that part of Micron's business. I think consensus on automotive in general is like quite negative, right? So like a lot of the like pure play automotive semis are extremely cheap right now. So I guess if you believe that thesis to be true, I guess why the expression in Micron versus like something that's directly levered to that theme, I guess.
Yeah, sure. So we looked at a few names in the industry, Indie Semiconductor, other names like you mentioned. And I guess the reason we ended up focusing on Micron mostly was because we thought, they have a very favorable revenue mix overall, but also they're in very many different markets. So that gives us, a little bit more, like it reduces the risk overall of the investment because they're in so many different markets.
Yeah, and just to quickly add on to that, another thing that we really wanted to focus on was long-term sustainability. So as we sort of highlighted earlier on, compared to its competitors, both its EBITDA margins as well as its leverage ratios are above average, which is really important because in this cyclical industry, you need to ensure that the people that you're buying into will be able to sustain those down cycles and actually come after them. So even if there's a stock that's maybe the cheaper at the time, we want to ensure that over the next 3-4 years, they'll be able to sustain.
On
Yeah.
that valuation piece, really quickly, guys. I think I saw forward PE of 13 times. Is that right? Or am I missing something? If you go down, I think this was later in the deck. Versus industry 31 times. Obviously, the bigger names are bringing that up, but I was wondering if you could speak to perhaps, why these guys are trading where they are currently, what accounts for the difference in the median there, and where these guys are trading it, and why do you see that gap potentially closing?
Yeah, sure thing. So I guess the reason we think Micron is so definitively undervalued, and the reason its multiple is so low is because investors really aren't appreciating how much growth they're going to have in their AI segment. And that was because they gave, a mildly negative Q1, a forecast in the Q1 earnings. That's the main reason over there. Yeah.
And what are these guys trading on? Is it forward revenue growth? Like, what do we think is the main driver here? Because it seems like
Yeah.
if we're trading down off, downbeat revenue growth, like below street revenue growth, and that's putting downward pressure on the stock, that's telling me, in large part, this valuation is driven by forward growth. And I know a lot of these names are, and we're expecting pretty robust forward growth here. How my concern, of course, is if you have such high expectations on growth and your trading is large part derived from growth expectations, how do you continue to sustain that valuation?
Yeah, for sure. So I guess there's definitely sell side is definitely concerned about that. That growth valuations are very high, but to that I'd say if you look at the big tech names and what they're projecting for CapEx, they're pretty much giving a blank check to these chip providers. I will mention a very interesting quote came out of Google's second quarter 2024 earnings conference, and their CEO is pretty much just like, we will spend whatever we need to in order to maintain our edge over here. And also, I'd like to mention that, recently we have Project Stargate being announced. That's like $500 billion of AI infrastructure spend. And Microsoft themselves have committed like $80 billion spending on that project. And, Micron's going to be a pretty big beneficiary of that, since the main goal of that project is to build out, AI data centers. So I'd say actually, growth projections from sell side are pretty dramatically understated.
Yeah, and the other thing that I'd like to add to that is, again, because of sort of the overstated pessimism from the recent earnings report, recent catalysts that are huge are just being undervalued. For example, their HBM supply is fully booked out through 2025. That's something that's, I think, pretty key. And
sorry, just quickly, what percentage of that is what is that as a percentage of their income overall? What's HBM?
HBM I believe should be on a slide.
Yeah, so HBM, we believe another great part about Micron is their currently HBM share is pretty low, and that's why they have a lot of room for growth, because we see that they're projected to kind of get the same level of HBM share in the broader market as they have currently in the DRAM market, which is around 20%. So they're growing from around low single digit percentage growth right now to up to about 20%, which is a large amount of growth that I think a lot of streets and analysts are missing.
On the growth point too, so you obviously mentioned the considerable amount of CapEx, and based on your valuation, seems like they're reinvesting the majority of, you have no path, they're then reinvesting the majority of that into CapEx. Do you have any view on, when those pretty aggressive CapEx investments are going to taper down, and within those CapEx investments, when the mix might change from being something like new CapEx construction to more of a maintenance type of CapEx?
Yeah, sure thing. So right now we think, Micron's CapEx has been pretty aggressive, and they announced that, they're going to increase their CapEx in 2025. It's going to be 30% more than it was the year before. So, they have definitely been like very aggressive with CapEx. As per when it turns into, maintenance CapEx, we'd say probably around 2027 to 2028, when we see like the AI growth story starting to slow down. But for now, they're definitely going to be, investing heavily into, make sure they're on, cutting edge and having the strong facilities.
Makes sense. Thanks.
I think you guys have spoken a lot about this like AI growth story and a lot of kind of trends in that area. Maybe if you could like walk through the revenue growth you had and exactly how you projected those numbers in some of the forward years and for each of the segments.
Yeah, sure thing. So for the CNBU segment, it's obviously, Micron's fastest growing segment. So we see, pretty enormous growth in 2025. The most recent quarterly report was like very, very strong at Q1 2025. We saw, AI growth becoming, increasing by 400% in that segment. So we model, growth pretty strong in 2025 and 2026. Although we do have to account for the fact that, this industry is pretty cyclical. So we account for that in the CNBU revenues. In the storage business, we see that growing at like, 11%, 15% per year. And now in the smartphone segment has been pretty weak. Competitor SK Hynix, reported earnings pretty recently. And their earnings in the smartphone segment were pretty lackluster as well. So we think, low single-digit growth here makes sense. It's also what management has guided for. Texas Instruments actually reported earnings, I think, this morning, and they also had some struggles in that segment. And in the embedded business unit, we see like ADAS adoption increasing pretty dramatically. And as a result of that, we see growth this year accelerating pretty dramatically. We can see growth in Q1 was pretty high, and then we see that increasing at a slower rate 2026 and beyond.
So
I
quick
guess yeah, a couple of follow-up questions
ahead,
like
Rohan.
on like the EBU, like from 110% to 11%, like maybe if you could like I guess explain why is there such a large drop off there. And then one of the other things you mentioned is in the CNBU business, you said there's something like 400% AI growth in that segment. Like what exactly does that mean? And how are you getting from like 87 to 37 to 7? Like these projections that I'm struggling to understand.
Sure. I can make that a bit more clear. So the AI segment of the CNBU, so AI accounts for the CNBU segment, which accounts for like half of overall revenue. So yeah, we're seeing like pretty aggressive growth in Q2, Q3, and Q4 in this AI segment, which leads to 86% growth for 2025. And we think like, this growth is like not as sustainable. AI CapEx will like go down from the big tech companies, which is why we see like, decreasing growth in 2026. And we're going to see a trough in 2027, followed by, increasing growth 2028, 2029, and 2030. And what was the next half of your question?
Yeah, I guess like explaining like the 110% to 11% drop off in EBU.
Sure. So that comes from, automakers, creating having an investment cycle in the ADAS adoption right now. And we think once they like sort of make those investments are going to taper off pretty significantly into the future. And so there we apply more of like a conservative growth rate.
All right, I think that that's time. Thank you guys so much. And yeah, great work. Thank you.
Cool. Magnite is a sell-side programmatic advertising platform specializing in programmatic ad technology that automates buying. Is the screen all right?
Yep.
Perfect. Buying and selling of digital advertising inventory across 3 segments: connected TV, desktop, and mobile. Our thesis consists of 3 parts. The first is that the street is underappreciating the Netflix partnership deal. Second, that there is an overlooked advertising ecosystem shift that will cause direct uplift for the equity. Third, a Google ad tech stack breakup is much more probable than the street anticipates, which could unlock significant value upside. Breaking out its specific CTV segment revenues, Magnite has ad serving fees and true programmatic ads through CTV marketplace, which both consist of 40% of top line. Additionally, there are managed services, which account for approximately 15% of revenue and has the highest take rate. As for its product offerings on the supply side, Magnite facilitates real-time auctions of CTV ad spots. On the demand side, Magnite offers their product Clearline, which offers first-party insights without the need for cookies. This is extremely important for advertisers. Eric will now discuss Magnite's sentiment and setup.
Thank you, Luke. So we believe Magnite is approaching a huge EBIT acceleration with the full rollout of CTV ad spend that will 3x TAM by the second half of 25 into the first half of 26. However, 3 reasons explain why Magnite stock has not fully reflected this growth runway. Since 2021, Magnite has made various CTV-related acquisitions, such as the acquisition of SpotX, a video advertising platform. However, the transition to CTV was only beginning, and that entire idea was not fully realized yet, so they had a couple earnings misses. In late 2023, more partnerships began forming, and Magnite was able to carry through with its deleveraging of its balance sheet. Since then, Magnite partnered with Netflix in the second half of 2024, and the price has only increased 15% as investors focus more on incremental improvements in CTV revenue and had general skepticism of the overall transition from linear TV to CTV advertising, despite an influx of advertisers. Magnite has also suffered setbacks from potential deprecation of third-party cookies, which we believe is fundamentally flawed. And as of late 2024, Magnite has made significant partnerships with OEMs and other streaming platforms, such as Disney, which will contribute to growth that we believe will be realized in late 25 and into 26. Now I'll be talking about the competitive landscape. At the top, we have full tech ad stacks, and that's Google Ads. They have a very broad reach within the advertising ecosystem, primarily focused on display and video. So imagine the YouTube video ads, pop-up ads, and banner images, text ads, that sort of thing. They lack individual specialization for companies. Since they have such a broad reach, they often miss targets, and advertisers characterize this as high cost and lack of pricing transparency. Next, we have TV-centric ad platforms, and that's Xandr and Freewheel. Now, these are linear TV advertisers. So imagine cable television and bidding for ad space on NBC, CBS, Fox, and CNBC. But advertisers express general concerns about biased inventory allocation because seller and buyer interests aren't entirely aligned within TV-centric ad tech. And that's where Freewheel, such as owned by Comcast, might give premium inventory to itself. Lastly, we have small independent SSP platforms, most similar to Magnite. They tailor experience for publishers that offer more control and transparency. However, most of the other SSP platforms, such as PubMatic and Nexon, often struggle to gain and maintain multiple partnerships. And the reason being, it's hard, it's difficult. And Magnite, being the largest SSP, has most of these partnerships. Now I'll pass it on to Haiar for Netflix.
Thank you, Eric. So upon the first things we have Eric has discussed about is the Magnite Netflix partnership deal. So since Netflix partnered with Magnite, sell side has focused lots on Netflix and little on Magnite, as is visible from the quote by the Magnite CEO, which basically states that a majority of researchers of the stock are coming to questions about Netflix, trying to gain insight through Magnite into Netflix rather than focusing on Magnite. So some background on the deal. Netflix has the lowest percentage of ad tiers users compared to the streaming industry. Some examples. On average, other streaming services hold a 49.5% of ad plans, while Netflix only 25.9%. Now, when you look at the revenue estimations of the street for Magnite, we noticed fairly moderate numbers, and we decided to apply our estimates towards the total subscribers of Netflix ad plan and derive our revenue from that. Now, to dive deeper in the calculation a little bit, we're using 32.81 as our total viewership hours, which actually represents 17% of the total viewership hours, while, as I already mentioned, 25.9 is the ad plan percentage of overall viewership. And multiply that by 4 ad minutes per hour, which is standard, and then multiply that by $35 of cost per minute by ad, which is actually the average we have managed to create from all of the different countries in which Netflix operates and the different costs per minute that it has there, and average that number. And then multiply that by the 5% take rate, which we have derived from our channel checks with the senior leaders of Magnite who were involved in the Netflix deal. Now, just to prove how conservative these estimates are, just recently, 3 days ago, Netflix has announced that 55% of its new subscribers are going into ad plan, with estimates ranging around from 40 to 45. So Netflix is well on track to beat our estimates quite handsomely. Just this goes to show how conservative these estimates are, which dive directly into our top line. Now I'll be passing it on to Eric to discuss thesis 2.
Thank you, Haiar. So for thesis 2, we're talking about a shifting advertising ecosystem. The whole pitch relies on this idea that linear TV is dying out and CTV is accelerating. So as the shift in viewership from linear TV to CTV accelerates, ad spending is also transitioning. The largest linear TV providers lost 5 million subscribers in 2023, adding to 4.6 loss in 2022. This reflects an ongoing annual decrease in subscribers of approximately 6%. But programmatic advertising, or CTV advertising in this case, which is what Magnite offers, still lags behind linear TV and has only recently picked up speed. Advertisers find more value in CTV due to its precise targeting and high completion rates, roughly 90%, and are willing to pay more, $35 versus $15 for CPM. We did channel checks with the senior advisor of Hulu and the CRO for Integral Ad Science. And for both of them, we can see that the focus is shifting from linear TV to CTV, and there's no shortage of inventory as Magnite is providing more. Additionally, we have tailwinds that we project rapid growth of up to 40 billion plus in 2028 with 17% CAGR, driven by a major shift in ad spend. The key takeaway is advertisers prefer the flexibility, analytics, and efficiency of CTV. Now this leads into our second point, which is we believe there's a fundamental mispricing of the TAM expansion. Additionally, CTV spend lags behind its share of TV consumption, accounting for 30% of ad spend, despite representing 40% of viewing hours. And 50% of CTV advertising is still transacted non-programmatically. And as programmatic advertising matures, the shift to replace non-programmatic advertisers will create easy upside growth for Magnite. Now, additionally, we use that bottom-up approach that Haiar talked about to build out TAM, and we believe that we can project a 3x TAM expansion into 2026 versus Street's 2x. Additionally, the Street is extremely cautious with fear of slower growth and implementation of CTV programmatic advertising. This is only further extrapolated by suggesting cookies deprecation by Google in 2025 is a key risk, and we think differently. Magnite offers a solution called Clearline, which is a self-service solution that provides ad agencies with direct access to premium video inventory and first-party data. We believe that this holistic identity solution is exactly what DSP buyers and publishers are looking for. And as third-party cookies disappear, there's no effective story for these large DSPs. And we believe that this will directly flow to Magnite and yield a take rate stabilization or possible expansion from 10 to 15% compared to the market average of 9%. This shift closely mirrors the programmatic shift in ad spend way back when with DoubleClick, which generated significant upside. And we see this as just one component of our thesis. I'll now pass it on to Xuan for thesis 3.
Yeah, so thanks, Eric. Our third thesis is that there is a potential Google ad tech stack breakup that will drive upside in Magnite's DV Plus segment. DV, or display and video, helps these teams execute digital advertising campaigns. So now let's take a look at the current market landscape. Google currently has around a quarter market share, while the other competitors fend over the rest. However, Magnite is showing great improvements in the DV space. Its DV Plus system has $85 million ex-TAC in 2024 quarter 3. On top of that, it's also up 5% year over year in revenue, and its take rates for DV Plus are typically between 15 and 20%, which are way higher than CTV. So now let's take a look at the current market landscape. Google is currently undergoing an antitrust suit where in January 2023, the US DOJ and 8 states have filed an antitrust suit against Google for monopolizing the ad tech market. With our conversations, we believe that Judge Amit Mehta's ruling will be favorable towards the DOJ, and safeguards will be enforced to ensure Google's compliance. Channel checks with the senior leader of the DOJ have also shown confidence that Google will divest from many major industries like DV360. Now, to give some context as to the timeline of the antitrust case, around 2 to 3 years ago, the DOJ filed a lawsuit against Google. Last year in August, the judge ruled that Google acted illegally, and in the past 2 months, both parties have submitted their remedy proposals. In August of this year, the judge will rule a remedy, which is more than likely divestment. Let's take a look at how this might impact Magnite in a post-divestiture market. A weakened Google would allow Magnite to attract publishers and advertisers, fortify its partnerships and maintain stickiness, enhance its appeal with modern products like Clearline, and establish a strong infrastructure compared to its competitors. Hence, Magnite can capitalize greatly on Google's divestment, which can leak into other departments like curation, where Magnite has proved its dominance by more than doubling year-over-year revenue in the past. Next, I'll be going on to the risks, mitigants, and the catalyst path. Firstly, many sell-side analysts argue that there will be a slower than anticipated transition from linear TV to CTV, which can compromise Magnite's growth. However, past figures and channel checks with advertisers and publishers in the space have revealed significant growth in ad spend towards CTV, while linear TV is being left behind. Beyond that, if we were to simulate the worst possible scenario, Magnite would still be well positioned. Magnite's DV Plus will maintain its revenue generation at 15 to 20% take rates as digital viewership grows at 9% CAGR, suggesting a strong hedge to any downside. Skeptics also believe that the CTV ad market is saturated with incoming SSPs and DSPs that have a better positioning than Magnite. However, Magnite's strategic services like SpringServe ensure that it maintains stickiness with some of the most prized partners in the entire CTV industry. Moreover, meetings with management suggested that DSPs are not as well positioned as many sell-side analysts think, as Magnite is adapting to different industry changes. Some catalysts that further enforce our theses include Magnite's top-line beats, as Netflix's success in its ad tier will fortify CTV advertising, and since Magnite has a first-mover advantage and established infrastructure, it would reap benefits directly to its top line. Magnite's DV Plus growth caused by Google's divestment of DV360 would also create strong revenue generation and increase future cash flow growth, fortifying our upside. Now I'll pass it on to Haiar for a financial summary.
Thank you, Yashwin. So upon a little bit of cost assumptions to go. Magnite, we expect their CapEx, R&D, S&M, and D&A to taper to closer to their long-term targets of 4%, 13%, 21%, and 9% respectively for those figures mentioned. And this is historically aligned with Magnite's position where upon the deal's announcement, they kind of ramp up their expenses in order to secure the deal, in order to look more presentable before securing a deal, and then kind of synergize and go forward upon getting that deal, which is fairly similar to what happened when they acquired Disney in 2021 and went on to decrease their expenses only to increase them forward before Netflix's acquisition as a partner. So thank you. And here are appendices. And we're now open to questions.
Hey guys,
Go ahead.
Hey guys, quite an interesting thesis. I think this is quite a great pitch. My one question was basically like, I wanted to better understand like Magnite's like international exposure. So is it the case that like as Netflix, expands internationally on the ad-supported tier, are they also having to take like in those international expansions as well? And I guess more broadly, like as CTV grows internationally, do you think that Magnite's well positioned for that growth as well?
Yes, of course, I can take that question. So if we go to thesis one, particularly, so international expansions pretty much focuses on one number specifically that is poised to change as the international expansion grows. It's the cost per minute. So when doing that specific model, as I've mentioned, we took the average of the US numbers and the European numbers and all the other international areas in which Netflix operates specifically. And even though the number may decrease due to the international expansion forward, if Netflix, for instance, for its ad plan grows more in countries where this cost per minute is lower, their viewership hours by the rapid growth in those global areas will decrease and kind of optimize the overall number forward. But Netflix in general is planning to, one of their main growth avenues, which they further reinforced in their most recent earnings call, is that they plan to expand in first world countries and kind of tap into that customer base, which does not want to subscribe to their premium plan, but still wants to access Netflix. And those are kind of, again, the countries in US and Europe where these take rates are substantially higher, around $60 to $70 in cost per minute.
So nice answer to that. Quick follow-up to that. Regarding customer concentration, as we're seeing, based on this, more of Netflix becoming a large part of the revenues, how do you view customer concentration changing in the future? And with that, how do you view the risk profile changing? And do you have any information on what these contracts might look like with these larger customers?
So again, I would take that question. So again, as Eric has mentioned before, the platform of Magnite is quite sticky, and on top of that, there's contracts in place. So just recently, I think it was October of 2024, Magnite has announced that it renews on a 2-year contract with Disney, and there has not yet been in scenario where someone closed their partnership with Magnite and moved on to some other SSP platform, which just in general shows that the risk profile when acquiring that specific partnership is quite low, considering the stickiness that it creates, especially Magnite with its being so global and so well positioned within the CTV industry. It's quite hard to find a replacement for that.
Sounds
that
good. Do you have
answers-
any view on, what percentage of their revenue might be attributable to a certain number of customers? Like perhaps let's say their top 5 customers are attributable to, what percent of the revenue? Do you have any view, even if rough numbers on what that concentration might look like?
Yes, of course. So for particularly our model here, we estimate again 30% growth from Netflix alone. Particularly because Netflix, unlike other streaming services, is fairly like badly positioned within the ad plan market, as I mentioned. Other streaming services, 49.5% of their total subscribers are on ad plan. Netflix is on 25.9. Again, and that kind of, it will take some time for Netflix to reach that threshold of 45.9 to be within the average of other streaming services. And so just because of that, through the longitude of our pitch, Netflix will be the main customer, attributing to around 30% of overall Magnite's growth. So a very, very important deal.
Thanks.
And just to double click on that, so you said, I think somewhere in this pitch, that new Netflix subscribers are 50% ad models and 50% premium. Is that correct?
So 55% of the new subscribers to Netflix, just as of the last numbers for the last quarter, about like 5 days ago, represent ad plan subscribers.
Got it. So is that something that's trending up? And as a follow-up to that, is the implication there that when Netflix raises its prices and more people transition to the ad models, that actually helps here for these guys?
Yeah, I can take that question. That's a great question. So if you look at how we calculate revenue at the very bottom, it's all based on total impressions. And if you have a lot more subscribers, we're going to see that estimated viewership hour increase. And under the assumption that we keep ad minutes per hour constant, keep CPM constant, as Haiar mentioned earlier, and this take rate constant, that's just increasing one variable that will increase the total revenue. So as we see, yeah.
So, and then on the recent Netflix earnings, they came in above consensus. Why aren't these guys trading up at all? Do we have a view on that?
Yes. So if you look at the sell side view at the very top left, this is the most recent earnings call that we were able to get our hands on, right? And this is after a Netflix partnership has been announced. Netflix was announced in the early second half of 2024, and this is in Q3. And Magnite reports slightly later. So the idea is that people look into Magnite as more of a way to get insight into Netflix's business rather than understanding Netflix itself, and rather than understanding Magnite itself. And we think people are only starting to pick up on this idea. As linear TV starts to die out more, CTV will take advantage, and thus Magnite will be the middleman.
Yeah,
Gotcha. But you're saying that they're lagging there, right? Like the transition from linear to CTV, the actual transition, we're not seeing advertising switch at the same pace. Could you maybe just talk to that point a little further?
Yeah. So at the end of the day, it still comes down to advertisers. Advertisers are already picking up on this, but the street overall has not. And actually, one of the points we mentioned earlier is, despite accounting for 30% of ad spend and 40% of viewing hours, that's talking about CTV specifically. 50% of CTV is still transacted non-programmatically, and that's growing. So we're seeing a rapid expansion in the market of 40 billion plus by 2028, 17% CAGR compared to digital advertising of roughly 9%. And that's the transition we're looking at right here.
Gotcha. And then maybe just to get away, and this is the last one from me, sorry to my other panelists, from the Google breakup here, that antitrust situation. So that's a big part of the thesis to me, and I see a lot of upside there. If that leads to these guys taking up additional market share. Do you guys have views on where their current market share stands, and if we get if this comes to fruition, which I believe you guys see happening, what does market share look like pre and post? And then just maybe as a prerequisite to that, can you speak to why you think the street isn't necessarily pricing this in and why you have a differentiated view? It seems like you guys are more convinced that this is going to happen than the street is, or at least the street is pricing it in less so than you guys. So be interested to hear your thoughts there.
Yeah, that's a great question. So we actually have reason to believe that this ag tech stack breakup is more probable. I mean, traditionally in the past, we had an EU antitrust. Google was able to skirt that with compliance. We did some channel checks with the former DOJ, and he was able to say that we're leaning more favorable to at least a moderate remedy for this breakup. Now, in our model, we didn't actually forecast a Google ad tech stack breakup. The reason being, it's very hard to quantify this upside. It's just basically significant upside, as you mentioned, right? We forecasted it based on however DV plus that revenue segment has been growing before, right? So now in this case, if we have a potential breakup, Magnite is going to benefit significantly, right? And that's because DV plus and as a whole aligns both seller incentives and buyer incentives. So they pose as a very significant middleman. And in this case, again, we still believe that there is a potential remedy. And if we look at the channel check quotes, the idea is that Google is not a monopolist, but a complete overturning is very unlikely. And that's the reason why we're leaning towards this, right? We expect DV plus to grow at the same amount, and in our model, it's included the same way, except any breakup is going to drive upside.
Gotcha. Thank you, guys. That's it for me.
Thanks, guys. I think, yeah, this interesting thesis. I kind of understand, like, the growth drivers. I think one thing that would be interesting to hear more about would be competitive dynamics. So I think obviously the thesis just relies heavily on this Netflix partnership, but I'm trying to understand, like, why, a few different things. Like one is like, what's the nature of these partnerships? Like, what's the duration? Is it like some, X number of year contract that it's locked in for? Why are they choosing Magnite as opposed to other sell side platforms? Like, is it they have most demand side platforms and most advertisers, and how easy would it be for a new partner or a new platform to kind of spin up?
Yeah, that's a great question. So actually, these contract renewals are typically 2 to 3 years, as what Disney did. And if you look at the competitive landscape, Magnite is actually the largest independent SSP provider, and they provide for CTV exclusively. The next largest independent SSP provider is PubMatic, and their largest major partnership is with X or Twitter. And the reasoning that we see where there's a differentiation is Magnite for the past 3 years has been focused on switching to CTV. And they're very well positioned for CTV. So if you have a large streaming service like Netflix step in, do a 2-year contract, we see a lot of upside there. So as you're locked in for those 2 years, Magnite is also doing stuff with their ad server, which keeps them locked in. That creates that stickiness. And if you get a large supplier of ads like Netflix stepping in, you'll get a lot of advertisers in that network effect. So at least for the 2 years that we believe, and at least our thesis is, our entire pitch is for 2 years only, we expect to see growth within this story. And especially since advertisers and publishers are going to be locked in with this network effect, we believe that that's creating this upside.
Got it. And then I think there's some other platforms as well that are in the model, I think like Disney and Hulu. So maybe if you could guys talk about what those partnerships look like as well. And is it like similar 2-year contracts, or kind of what's the rest of the revenue?
Sure. So with Disney, Hulu is actually a partner with Magnite 6 years ago, and Disney renewed their 2-year, did a 2-year renewal contract this year, and they've done business with Magnite in the past. In fact, Disney was actually giving more of their sports streaming services to Magnite in this contract recently. And I think that really highlights Magnite is very well positioned for this growth.
Do you know why they might have turned in the past? Like why, like they used Magnite before and then I think now they're starting again, but what was kind of the gap?
I actually don't think there was a gap. I think they were with Magnite consistently. Their contract expired and they just chose to renew it.
Okay, got it. Makes sense.
I think that's about all the time that you guys had. Great work. And yeah, thank you for presenting.
Thank you very much, judges. Thank you for your time.
Thank you for your time. Good afternoon, everybody. My name is Kenneth Bakir, and I'm here with Anikwe and Jonah Salages, and we're here with a long investment recommendation of VSTS. This is the agenda for today, and we'll start with the company overview.
So Vestis is a leading provider of uniform rentals and workplace supplies across North America. It was formerly known as Aramark Uniform Services until it was spun out in September 2023. After Aramark began to focus on the core Aramark food service segment. Vestis now currently has around 20,000 employees and approximately 350 nationwide facilities and has a leading route coverage program. Vestis operates as a business-to-business services firm with over 300,000 customers and has extensive operations across North America daily. Now, for the revenue breakdown, it generates through two main segments: services, which is 94% of revenue, and direct sales, which is 6% of revenue. Historically, over the last 4 years, the EBITDA and operating margins decreased initially and in the first year and has been increasing the last few years. Now for the business model, Vestis operates as a stable, predictable, and cash-generative business supplying and servicing uniforms and workplace supplies. Their model is driven by a recurring revenue structure and sticky customer relationships with 92% of revenue locked in through multi-year contracts. This ensures high retention rates, averaging 93%, and long customer tenures of 11 years for SMEs and 26 years for large accounts. The company serves a wide array of industries from manufacturing to hospitality and leverages its diversified client base to expand operations. Now, for the uniform rental process, it's under a 3 to 5 year contract. Employees receive 6 uniforms weekly, wearing 1 while 5 are laundered by Vestis. At around $7 to $11 per wearer per week, prices are about 30% below the industry average, highlighting pricing inefficiencies. Vestis capitalizes on deliveries by swapping out additional items like towels, floor mats, and first aid kits at no extra costs, which expands revenue with minimal marginal costs. Additionally, uniforms are amortized over 18 months, creating a lag between costs and profitability. The overall offering split includes 92% recurring services, emphasizing recurring revenues' importance.
All right, getting into the industry overview, Vestis is positioned in a large, underpenetrated market with significant growth potential. The uniform and workplace services industry is valued at $65 billion, projected to grow at 4.3% annually through 2031. This sector is highly fragmented but attractive due to its substantial barriers to entry, stemming from the complex network requirements to capture market share. Key drivers for the industry include the routine and cyclical nature of operations, which provide consistent revenues through multi-year customer agreements. Moreover, companies in the space prioritize customer service, cost efficiency, and integrated product offerings to grow and retain their client base. Sector tailwinds include a shift towards a service-oriented economy, regulatory pressures favoring safety and hygiene standards, and industry consolidation converting one-time buyers into long-term customers. Notably, 75% of the market is either controlled by local players or remains untapped. Vestis has a 7% market share, making it well-positioned alongside its competitors Cintas and UniFirst to capture market share with minimal competitive displacement. Now, let's take a look at the industry performance. The industry's leading players have built their success on margin-accretive cross-selling, roll-up M&A strategies, and a fixed-cost business model that capitalizes on economies of scale. Cintas, in particular, has presented themselves as a clear leader in scale-driven margin expansion, maintaining profitability through economic cycles. In contrast, UniFirst has struggled with lower margins due to its growth at all-cost strategy, which smaller players adopt but fail to compete with fixed-cost efficiencies at scale. For Vestis, its history as a previously neglected asset under Aramark left operational inefficiencies. However, the company is now unlocking hidden value by optimizing route density, enhancing customer capture, and prioritizing high-margin stock keeping units, as reflected in the operating margin trend over the past decade, which you can see in the graph below. Vestis' recent focus on leveraging frequent client interactions for cross-selling and upselling further supports the business model's consistent multi-year revenue generation, creating structural customer relationships and room for sustainable marginal growth.
So why bother with uniform workplace supply rentals? The answer lies in their ability to provide a service that represents a minimal component of their customers' cost structure, less than 1% of total spend in most cases, while retaining critical to their day-to-day operations. Some benefits include, for safety purposes, they cater to industries where uniforms are necessary for worker protection and adherence to regulatory requirements. The cost-effective solution, their scale allows them to provide lower cost solutions compared to businesses managing uniforms internally, especially in high turnover businesses. Small cost, big relief. For customers, Vestis' services are a small and non-intrusive expense that addresses a critical need, freeing up resources for their core operations, allowing them to focus mainly on their core business. For consumer expectations, uniforms also enhance branding and customer experience, which is key in industries like retail and food services, where appearance is directly tied to consumer trust. So for the investment merits, Vestas represents a compelling investment opportunity with a clear path to value creation. Thanks to its position in an underpenetrated market with around 40% of the 48 billion total addressable market still self-serve. Vestas has significant room to grow with minimal competition. Some core drivers of success are its recurring revenue structure with weekly recurring revenue and a short conversion cycle, which ensures strong free cash flow generation. A 50% EBITDA to free cash flow conversion rate supports flexibility and resiliency during economic downturns. They also have ingrained customer relationships, which results in high switching costs, providing a cushion for growth and stability with industry low CapEx at around 3% of revenue.
Moving on to our first thesis, Vestas' recent spinoff creates a unique opportunity to unlock value through margin accretive additions to its operations. Management has highlighted cross-selling as a key growth driver, with a focus on underpenetrated high-margin product categories like floor care and safety, which currently represent just 15% and 2% of revenue, respectively. Customers only use 30% to 40% of Vestas' full line of products and services, presenting what management calls a significant opportunity to grow wallet share. To quantify this, cross-selling just one additional product expands margins by 300 basis points on average. Combined with Vestas' massive operating leverage, this could drive nearly $900 million in incremental annual revenue. Additionally, Vestas boasts the highest customer satisfaction rate among peers at 74%, despite its lower cross-selling presence. This highlights the reliability of its core offerings and creates a strong foundation for growth. What sets Vestas apart structurally is its single route infrastructure, which integrates the delivery of core and ancillary products. Unlike competitors that rely on separate trucks for ancillary offerings, this advantage enables Vestas to efficiently scale cross-selling, particularly for high-margin, recurring revenue products like heart defibrillators and IWAS stations. With excellent fundamentals, a clear strategy for margin expansion, and structural advantages over peers, Vestas is well-positioned to capitalize on this untapped growth potential.
All right, to take a look at thesis 2, Vestas can revitalize their organic growth by leveraging a retain and gain strategy. This approach is powered by Vestas' exceptional customer retention rate of over 90%, coupled with its recently implemented internal system, which integrates CRM, routing, and inventory management. These digital tools create a data-driven framework for identifying pricing inefficiencies and addressing customer needs in real time. Key operational improvements would include optimizing route check-ins through predictive analysis and streamlining customer onboarding from over 8 weeks to down to just 4 weeks. This new digitized process enables sales teams to engage directly with customers, which reduces paperwork and enhances contract efficiency. These measures not only improve customer satisfaction, but also strengthen Vestas' ability to cross-sell and upsell services. On pricing, Vestas has historically implemented incremental increases of 1% to 2% annually. However, through our data scrape and a look at national enterprise accounts, it was uncovered that there's a significant underpricing, particularly in high-use stock keeping units and multi-stop services, despite the comparable quality and service to competitors. As highlighted, the average discount across Vestas' stock keeping units is approximately 15%, which creates a clear opportunity for defensible pricing adjustments. These adjustments align with Vestas' strategy to maximize value from its existing customer base, which is a key driver for organic growth and margin expansion.
Now on to thesis 3. Vestas has significant opportunities to improve efficiency by lowering COGS and enhancing margins through 2 key areas: network route optimization and advanced merchandise management. So first, for network route optimization, they can restrict service distance. Vestas' historical routes show inefficiencies due to territorial crossover and redundant customer flow paths. By constraining delivery truck radii, they can minimize redundancies and improve delivery efficiency. They can also maximize route density. Predictive analytics can guide sales teams and drivers to target clients along optimized routes, balancing expansion and retraction strategies based on the cost to serve. They can also redeploy capacity efficiently. Vestas can train employees to handle multiple roles, making better use of idle labor and central plans to upgrade existing sites instead of building new ones, a prior business practice. And they can also advance merchandise management. There's a pressing need for improvement. Historically, merchandise tracking was manual, leading to inefficiencies and lost inventory. As merchandise accounts for 1/3 of total COGS, improving tracking and inventory reduces costs and enhances free cash flow. For stockroom optimization, Vestas can increase utilization of high SKUs and implement a nationwide stockroom program to maintain consistent inventory management across all locations. Finally, for the channel checks recognition, by standardizing inventory tracking and reporting processes, Vestas can improve SKU utilization. A former vice president identified merchandise control as one of the top 2 profitability drivers alongside customer retention. So there is proven success, as shown in this case study from Southern California. The key results were A 30% increase in revenue per mile. By implementing this program, Vestas achieved a significant uplift in margins, leveraging their favorable cost structures. Management projects around 30 to 50 million in cost savings by fiscal year 2028. And there was also a reduction in fuel consumption as the optimized trucking network resulted in 1,000 fewer gallons per week consumed, which led to a 21% decrease in distance traveled. Vestas successfully reduced travel distance while serving the same number of customers in Central Florida, 3,704. This demonstrates enhanced route density without compromising service quality.
Further supporting Vestas being primed for growth is their management team, which has been recently refreshed in the past 2 years. The new management team and board have over 25 years of experience each, with 3 members having significant careers in the industry, specifically uniform laundry and workplace services. For instance, Chairman Philip Holloman spent 22 years at Cintas, including 16 years at which he was COO, while Tracy Jokinen, former CFO of G&K Services, helped oversee its transformation before being acquired by Cintas. Chris Synak, former CEO of Neovia Logistics, spent 16 of his career at Cintas as well. These leaders are joined by 5 non-executive members who also bring substantial experience, having held CEO and CFO roles at companies like Brinks, ADS, and Waste Connections. This deep industry knowledge equips them to lead the company towards continued success.
Moving on to our valuation, our discounted cash flow analysis presents a 52.4% investment premium for Vestas through the Gordon growth and exit multiple method. In projecting out revenues and free cash flows, we utilize several key assumptions. Firstly, we projected revenue growth from 4.9 to 7% from 2024 to 2029, which we believe is rather conservative given the industry CAGR of 7.7% and analyst prediction. This growth reflects Vestas' operational improvements post-spinoff. Secondly, our model incorporates our first thesis here, with margins improving over 2024 to 2029 as management explores those cross-sell margin accretive opportunities that we mentioned earlier. Our other assumptions, including D&A as a percent of revenue and CapEx as a percent of revenue, follow industry standards and averages for them. Next, we calculated the weighted average cost of capital, incorporating Vestas' equity beta of 0.77, a risk-free rate of 4.4%, and the expected market return of 7.7% to get a WACC of 5.9%. We found the terminal value through both the Gordon growth and exit multiple method, and our exit multiple of 9.3x is also conservative, as Vestas' operational improvements should draw them closer to the industry leader, which is Cintas at 28.8x. Lastly, we use this WACC to discount the terminal value and projected cash flows and bridge from enterprise value to equity value to arrive at our investment premium of 52.4%. Moving on to risks and mitigants, Vestas has several key attributes that mitigate the risks of high unionization relative to peers, industry-wide contractions, and a historical failure on the part of management. Let's start with the workforce. Vestas maintains a performance-driven employee culture that has effectively mitigated the impact of wage inflation. Furthermore, its top competitor, Cintas, has a history of acquiring companies with unionized labor. This provides confidence in Vestas' potential exit strategy, ensuring that labor-related issues wouldn't prevent a sale or a partnership if Vestas decided to follow a similar path. Regarding macroeconomic resilience, Vestas is built to weather economic contractions. With multi-year contracts, an asset-light recurring revenue model, and structural switching costs, Vestas is shielded from substantial losses during downturns. For context, 60% of its sales are tied to non-employment dependent products like first aid and mats. And during the 2008 crisis, Cintas, a top industry competitor, experienced minimal losses, and UniFirst actually grew their EBITDA, suggesting that Vestas is well-positioned to navigate recessionary pressures. Lastly, the company's operational improvements are driving long-term growth. The refreshed leadership team, including the former COO of Cintas and CFO of the top competitor, is overhauling outdated systems. This demonstrates a commitment to improving retention, efficiency, and organic growth, which will position Vestas for success in the years to come.
Just
Moving on,
a minute left. A minute and a half.
Moving on to our first catalyst, Vestas has recently spun off, and this newfound focus on core operations will drive profits for shareholders. Their position as a spin-off company presents the firm as a high potential opportunity for investors, and the specialized management team will drive long-term value.
And also for their earnings calls, Vestas currently has an underinflated EBITDA due to heavy investments in research and development and with their route optimization and merchandise management. This results in an underinflated EBITDA multiple relative to industry peers. And the upcoming earning calls will show Vestas' true value as EBITDA as normal as its investments will eventually be paying off.
Looking at our third and final catalyst, we see increasing regulatory pressures helping shareholder returns, as compliance with workforce safety regulations is non-negotiable, which drives consistent revenue growth for providers like Vestis. Companies increasingly outsource regulatory services, finding it more cost-effective and less complex than managing them in-house. This stable demand, paired with expanding margins, will enhance the business's financial attractiveness. And thank you for taking the time to listen to our presentation. We will now open the floor for any questions you may have.
Great pitch, guys. Real quick question on, the valuation piece. You mentioned, they have a multiple right now. You're estimating around 9.3, and that's going to around move towards the top competitor Cintas at 28.8. Typically seeing, 20 turns more in a multiple means that something is differentiated, whether that's the company itself, the industry you're comparing it to, or the competitor we're looking at. So my question is, we'd just love to hear your thoughts about why these multiples are so different, especially if you're considering Cintas as their number one competitor, and why you think that they'll be moving more towards this multiple that's, really 20 turns up from where they are right now.
Yeah, I can take that one actually. But so while Cintas trades at like a 28.8 EBITDA multiple, Vestis trades at just at around 9.3, and the discount is mainly due to like legacy inefficiencies under Aramark before pre-spinoff. And as Vestis optimizes routes, expands cross-selling, and improves margins, it can achieve. We don't believe it's going to achieve all the way up to Cintas's 28.8, but we believe the margin between the two are going to close up, and we believe it could achieve up to like around a 15 times multiple after it implies all those more route optimizations and efficiencies as well.
That makes sense. And do you have any view on where their other competitor trades at too? UniFirst, I think it was.
Yeah, I think Jonah has answer on that.
Yeah, so UniFirst trades at 11.3 EBITDA multiple, which we believe is like Vestis will approach that at some point due to the what kind of was saying before, the operational efficiencies, but they're not really leading the industry. They're just a more established business within the industry, as Vestis is rather new due to the recent spinoff. So we believe once they get things up and running, they will also outcompete UniFirst as well.
Makes sense. Thank you.
And sorry, one last thing I forgot to mention earlier too, is that like I had mentioned earlier in my other thesis slide, since they've done it, like invested a lot in their like research and development and stuff, their EBITDA is currently undervalued, and post spinoff they had to lever a lot of debt as well. So they've been paying off that debt as well. So their EBITDA is like kind of underinflated. So the EBITDA multiple is like going to be undervalued by the market. Although like the true value, which will be seen, I feel like in the next few, I don't know how soon, but like within the next maybe like 3-4 earnings calls, when the EBITDA returns back to normal, I think then the market will realize, Vestis should be able to be trading not all the way up at Cintas, but we should be trading at least up to UniFirst and even more, and just continue growing as well.
Awesome. Thank you.
Hey guys, super interesting pitch. Thank you guys for taking the time. My one question, I guess, to build on some of what Nay said, was essentially with this spinoff being basically like, now out for over a year or year and a half, do you kind of still see opportunity for like value unlock? And, it's obviously like done tremendously well since then, but like, do you sort of think that the public markets like don't understand the business yet or don't see the opportunity? Like, do you sort of still see that spinoff discount priced in, or like, is there some like further kind of realization post spinoff even after a year after the spinoff occurred?
I think that there is significant room for growth still, as you can see, kind of incorporated into our valuation, because a lot of these cross-sell offerings that we mentioned earlier have not fully been explored yet by Vestis, and that is something that they plan to do as they roll out into 2025. And then going to kind of how they're overhauling their systems. As we mentioned before, those uniforms take up a third of COGS. And so as we start to update these systems and not throw out these uniforms before their useful life, we're going to see a lot of these improvements. And as you can see in the valuation summary that's on the slide right now, you'll see those margins improving and increasing from 2024 to 2029, which is why we see this significant opportunity for investment within Vestis.
Thanks, guys. It's an interesting company. It feels more like a PE-backed company, so I'm interested in how it's trading publicly, especially at this size. I guess I'm more interested to hear a couple questions. One is like kind of about the dynamics of the spinoff, like any additional color on why Aramark kind of spun off this asset. I get that it's kind of non-core and maybe there was some operational drag, they weren't kind of focusing on it, but I think even since it's spun off, it seems like revenue has declined, so has kind of every kind of line item below that as well. And so I think some of the value improvements you're talking about, maybe are they like, supposed to be projected for the future, or maybe like, why haven't they been realized in the past year? And then the second question out of curiosity, how did you guys come across this company?
Oh, sorry. Can you repeat the beginning of the first question? We'll answer the first question and the second
Yeah,
question.
the first one is just like, why, I guess, wanted to hear more about dynamics of why Aramark spun off this asset. And kind of second part of that first one is, why some of the improvements that you spoke about haven't really been reflected in the financials, and when they're, expected to realize.
Yeah, I can take this one, but the primary reason that Aramark spun off from it was because they had misaligned goals, and Aramark particularly underinvested in Vestis, and they didn't feel like it was a valuable asset to the company. So Aramark was not focused on specifically the uniform retails and services market or industry that Vestis operates in, which originally led to a decline in Vestis' stock and like plummeting in May of 2024. And because there was this lack of operational efficiency, their pricing projections were underestimated a lot, and there were a lot of service gaps with the company. So with Vestis now operating on its own, the market doesn't really see how much upside potential it really has, because as of right now, they're trading at a discount because they're a newer company. The management team was recently refreshed, so they have a lot of room to restructure and build the company off, because a lot of them are from the industry leader of Cintas. And additionally, like as I was saying in thesis 2, they're trading at an average of a 15% discount. And once they fully realize that they have this defensible pricing increasing power, they will be able to generate more revenue and net income, making it a more attractive business to invest in the future. And also, to answer your second part of the question, we chose the company because we were originally looking at Aramark because it was a company that we've been seeing a lot recently, like in our area. So we were doing research originally on Aramark, and when we discovered the recent spinoff with Vestis, it just led us to look more into the company because we wanted to see how Vestis was as an investment opportunity and if the company had any potential after the spinoff. And as we were doing more and more research on Vestis, we just found that it was a very interesting company to do our due diligence on and provide a perspective on that the street doesn't really have. And we found the company was well positioned for growth, as we said, and we wanted to share that with you guys today because we thought it's a very interesting opportunity.
Sounds good.
Thanks, guys. Couple questions from me, I guess, sort of high level company positioning. So I think at one point you mentioned that prices are lower, and that's a positive, right? Obviously from customers' perspective, but it seems somewhat problematic to me, especially when we have price increases here. I think you mentioned 1 to 2% a year, which recently is lagging inflation. And then also you don't have very strong customer pricing power, given this represents less than 1% spend. So there's a couple high level sort of drawbacks for this company from a competitive standpoint. And so it makes sense to me in a more commoditized market, right, that we've seen a lot of consolidation, we've seen a lot of roll-ups. Like to Rohan's point, this seems like a private equity backed business to me. It would seem to make more sense almost in the private markets where you can get more capital behind it, delever post-spin, and then go after targets. So I guess my question to you guys is, leaving aside, the thesis points on optimizing on operations, how does this company think about, taking additional market share and maybe leveraging that to increase pricing power? Because right now it seems like the high level drawbacks of this industry from a competitive point of view is dragging on this business, and they're not really doing what their competitors are doing and consolidating and then increasing prices. So I'd love to hear your thoughts at a high level about sort of those drawbacks.
Oh, yeah, so we found that, I guess, primarily with Vestis' strategy, that they rely on their customer retention rate because they have over 90% customer retention, which is just leading the industry. And utilizing that, they're able to have the defensible pricing increases because it's not really a prospective M&A opportunity because they weren't given the chance to operate as their own entity for a long enough time to see growth in the future. So now that they have this new set established management, they're building off of a customer retention strategy, which although includes the route check-in, which other companies are doing, they're providing comparable products to these companies at a lower price, and which draws in the customers, which allows Vestas to have a defensible pricing increase, which will drive their value further on in the future. And we believe that's what sets them apart from their competitors, as they rely on the competitors such as Syntis and Universe rely on big name products and just having this larger scale of operations, as Vestas is able to operate based on a customer-sided pricing efficiency like layout to further progress it as an
So
opportunity.
are they taking share organically then by offering these lower prices, or are they sort of maintaining market share, drawing customers in with lower prices and then trying to cross-sell? Like, what, I don't understand what the advantage is here of offering a service at a lower price just to maintain, you know, customer retention.
Yeah, I can take that. So yeah, they as one of our theses, I think it was the first thesis, they are doing a lot of stuff with like cross-selling as well, as they're trying to go into like floor care, safety supplies, and first aid kits, which are a lot less marginal costs. So it's like they're adding the additional like it's like I had no additional marginal costs, and they're getting more revenue by cross-selling to their product to their customers. And they actually like differentiate themselves with like by enabling like seamless integration of those products during uniform pickups. And like competitors like Syntas require like separate deliveries for those services, but Vestas can actually add it into their delivery services, and that would cause their competitors to raise their costs, while Vestas does it at no marginal cost, additional marginal cost. And Vestas also has the highest like customer satisfaction rate from a survey, 74% in the industry, which indicates strong like customer loyalty and service quality.
Got it. And just lastly here, has Vestas talked at all about potentially consolidating, buying other businesses, or is it sort of like already a relatively consolidated space, and so there's not really an opportunity for them to expand inorganically?
So yeah, no, they have like the new management team has wanted to try doing that, but it's kind of difficult for them from the post spinoff, as they're still kind of having to deal with like all the debt that they've had to pay.
They don't have the capacity right now. That makes sense. But is this like a 2027, 2028 consideration, like down the line? Okay.
Yeah, definitely, because like I mentioned earlier, 40% of the total addressable market is like small minor companies. So they're basically just competing with Syntas over acquiring those smaller regional, like local regional companies as well.
And adding on to that, the new management team, as we mentioned before, is actually from Syntas and my competitor UniFirst. And so these people, you know, they have experience within the market with these acquisitions and how they can drive value for their business. And so as you know, they start to make these improvements within Vestas, we likely will see something like that, you know, thinking in the more 2027, 2028 range.
And so have you guys modeled it all, or not modeled, but perhaps just looked at, you know, debt levels post-spin? Because obviously they would have done a dividend back to their parent company. Debt levels are going to be high. How is that debt trending? Is that under control? How's it in fact impacting cash flows? How are you guys thinking about that, sort of the debt deleveraging there?
Yeah, so we didn't do a lot of research on that, but we know post spinoff they originally had like around, I think 1.5 billion, I think was that they levered off. But they've been like paying it off, and they've been on track with paying it off. I don't know exactly what it said through the in their 10K, but I think like it's not like a struggle, like they're not struggling to pay it back or anything from what we've researched.
Okay. Thanks, guys. That's all for me.
Yeah, I think that's all the time that we have. Thank you so much, guys, for presenting, and yeah, great job. And yeah, you guys are the last ones, so thank you to everybody who came and attended and watched. And yeah, I guess future is super positive from all you guys from the Freshman Showcase. But yeah, have a nice night, and yeah, we'll get back to you.
Thank you, guys. Great pitch.
Thank you.
Thank you.
Thank you very much.